When you're a kid playing hot potato, the rules are simple. Music plays, you toss the potato, and you hope you're not holding it when the music stops.
Harmless game, unless you lose.
Now, scale that up to roughly 20% of the United States economy. The potato is the financial risk of paying for medical care.
And at that scale, it stops being a game.
Welcome to the deep dive. We're pulling from the SWFT Market Intelligence Brief for the week of August 10th through the 17th, 2026. The through line this week is simple. Hospitals, insurers, employers, everybody is trying to push risk onto somebody else.
From prior auth to billing codes to direct-to-consumer weight loss drugs, it's all the same story. And eventually that risk lands on the individual.
Because everybody knows the math is getting worse, medical inflation is outpacing what anybody wants to pay, so the system is building defenses.
Let's start with the most familiar one, prior authorization.
The 2025 federal disclosures suggest it may be even worse than it feels. Insurers are denying at least 1 in 8 standard prior authorization requests.
And the rates vary by market. About 12% in Medicare Advantage, 14% in Medicaid managed care, and 18% in Affordable Care Act individual plans.
Then you look across carriers and it gets even more striking. Denial rates range from about 2% to 25%, depending on the company.
So for some plans, 1 in 4 requests gets denied.
Right. And when patients or providers actually appeal, they often win. So the friction itself starts to look like the strategy.
Delay the surgery, delay the drug, hold the capital longer, earn the float, and count on attrition.
Exactly. A lot of patients and clinic staff just run out of energy. But now employers can see those denial patterns, and they're starting to judge insurers not just on network size, but on how much administrative misery they create.
That brings us to one of the stranger battles in the brief. PatientRightsAdvocate.org is suing the American Medical Association over the copyright on CPT billing codes.
Which sounds almost ridiculous, like claiming ownership of the alphabet and charging people to write sentences.
But CPT codes are the operating system of healthcare commerce. Claims, data tools, transparency metrics, all of it runs through that nomenclature. And because the AMA holds the copyright, developers and health systems pay licensing fees to use it.
The plaintiffs argue that if federal regulations require those codes, they ought to be in the public domain.
And if that happens, the administrative barrier drops. A startup trying to build a tool to help patients shop for an MRI doesn't have to eat those licensing costs.
Which could remove millions in overhead and speed up independent price transparency tools. Even CMS is starting to question why a federal apparatus depends on a privately owned standard.
Now shift from private friction to regulatory friction. The No Surprises Act was supposed to protect patients from nasty out-of-network bills, but the Fifth Circuit just struck down a major piece of how insurers were calculating benchmark rates.
The so-called ghost rates issue. In the independent dispute resolution process, basically arbitration, arbiters use a benchmark to decide what's fair. Insurers were accused of excluding certain incentive payments and pushing that benchmark artificially low.
So they made the average look lower than it really was.
Right. And after that method got struck down, providers started winning roughly 85% of those disputes against insurers.
Which means insurers are paying more than they expected, and those costs get pushed to the self-funded employers financing the plans.
At the same time, Medicare is squeezing hospitals from another direction. Starting in 2028, CMS is forcing hospitals into bundled payments for 90 days after hip, knee, or ankle replacement.
Instead of paying separately for the surgeon, hospital, and rehab, CMS gives a target price for the whole 90-day episode. Come in under, keep some savings. Go over, take a penalty.
But ambulatory surgery centers are excluded, and the brief says participation adds about $1.4 million in administrative cost per hospital every year.
Which is the part that makes you stop. CMS wants savings, but a hospital has to spend $1.4 million just to run the reporting and tracking.
It's counterproductive for the hospital, but rational for CMS. Medicare gets macro-level savings by pushing the administrative burden downstream.
Classic waterbed effect. Push down in one place, pressure pops up somewhere else.
Hospitals run on thin margins. If Medicare imposes $1.4 million in compliance cost, the hospital has to recover it somewhere.
Usually from commercial plans and local employers.
And that's before you add Medicaid work requirements. The Brookings analysis in the brief challenges the basic assumption there.
The assumption was that people lose Medicaid because they got a job and earned too much. The analysis points instead to administrative disconnection,
Meaning paperwork, redetermination packets, missed mail, broken portals, reporting burdens.
so somebody can be legally working, still eligible, and still get kicked off the program because they missed the process.
Right, administratively purged. And when coverage disappears, the illness doesn't. People still show up to the emergency room, now uninsured.
Which means more uncompensated care, which means the waterbed effect again. Hospitals take the loss, then raise prices on commercial payers.
And whether they can do that depends a lot on geography and consolidation.
If you're the only hospital system within 50 miles, you have leverage.
The North Carolina example is blunt. Same basic knee replacement, same Blue Cross plan, roughly $16,000 at Catawba Valley Medical Center, around $40,000 at Mission Hospital in Asheville.
2.5 times as much for the same surgery.
That's what consolidation looks like. Between 2002 and 2020, there were more than 1,000 hospital mergers in the United States. In a lot of markets, the dominant system can effectively say, pay our rate or your employees won't have an in-network emergency room nearby.
So employers need another way to fight back, and that starts with claims data.
Historically, they trusted insurers and PBMs to negotiate well on their behalf. That blind trust is fading.
Employers with strong claims data access are using an average of 11.9 cost control strategies. Those with limited access use 7.9.
Because once you can see the $16,000 hospital, you can steer people there, waive the copay, direct volume away from the monopoly, and at least create some leverage.
The same rebellion is happening in pharmacy. The big three PBMs, CVS Caremark, Express Scripts, and Optum Rx, still control roughly 80% of claims. But 46% of surveyed employers are now contracting with alternative PBMs outside that group, up from 37% a year earlier.
Because they're tired of spread pricing. Charge the employer $100, reimburse the pharmacy $20, keep the $80 spread.
So more employers are moving to pass-through models, while insurers themselves are under strain. Nearly 3/4 of health insurers posted operating losses last year.
And that drives margin recovery, which usually means higher premiums and tighter utilization controls.
Problem is, the consumer is already at the wall. Nearly 4 in 5 adults say premiums or out-of-pocket costs are healthcare's biggest problems.
And still, 48% of large employers expect to make changes next year that increase employee out-of-pocket exposure.
Which is why the traditional group health plan is starting to look structurally unstable.
Employers want a cleaner exit. That's why more than 20,000 companies adopted health reimbursement arrangements in 2026, a 53% jump in 1 year.
It's the 401k-ification of health insurance. Same logic as the old pension shift, move from defined benefit to defined contribution.
Instead of guaranteeing a group plan, the employer gives a fixed budget and sends the worker into the individual Affordable Care Act market.
Because high deductible plans have hit a ceiling. A $10,000 deductible for someone making $50,000 a year is basically unusable.
HRAs let employers cap liability rather than keep absorbing unpredictable medical inflation. But that also changes the economics of Affordable Care Act risk pools.
Meanwhile, consumers are looking for lower friction ways to get care outside the hospital system, especially for high-demand drugs.
Which brings us to GLP-1 obesity medications. Analysts are forecasting an obesity drug market that exceeds $100 billion, with more than 100 million U.S. adults classified as obese.
Historically, one barrier was the injection. Weekly needles are a meaningful hurdle.
And Novo Nordisk's chief executive is predicting oral GLP-1 products, daily pills, could capture 50% of the market by 2030.
Take away the injection friction, and you likely expand the treated population.
The infrastructure is already forming around that. Telehealth platforms like Hims and Hers grew subscribers 19% to 2.9 million users, and they're projecting up to $3.3 billion in annual revenue.
And they're leaning into branded obesity drugs inside a closed-loop consumer model. No referral, no long specialist wait, no hospital billing office.
You bypass the hospital entirely. But that creates a new question for employers. Does this lower overall cost or just replace episodic care with a long duration pharmacy expense?
That's the real shift. Bariatric surgery is a one-time capital expense. A GLP-1 prescription is continuous utilization.
So, yes, the direct to consumer model lowers friction, but it also bypasses traditional networks and creates a utilization curve that's harder to predict.
And that's the theme running through all of this. The $1.4 million compliance tax, the $40,000 knee replacement, the 53% jump in HRAs. This is not just inflation.
It's a risk distribution problem. Hospitals push risk to commercial plans, insurers protect margins and push risk to employers, employers cap liability and push risk to individuals.
And the individual is the final backstop.
So whether you're fighting a prior auth denial, staring at a $40,000 hospital bill, or trying to navigate an HRA after your employer changed the benefit design, you're seeing the end of the hot potato.
The institutions protected their balance sheets, the individual absorbed the shock.
Which leaves the uncomfortable question. If 4 out of 5 adults are already tapped out, what happens when the last person in the chain can't pay or won't?
What happens to the whole game when the consumer can no longer hold the risk?
Something to keep in mind the next time you open a medical bill.
Thanks for taking the deep dive with us.
We'll catch you next time.
Stay swift.